Welcome to the #1 real estate podcast you must follow in 2021. This is the Truth About Real Estate Investing show, and please don't take my word for it. Feedspot.com listed us as the top of their list for the top 40 Canadian real estate podcasts. So that's all real estate podcasts, including investing. I've been podcasting since March of 2016, and before that was the Mr. Hamilton blog for several years. So no different than investing and the journey to financial freedom. It's a long game. No overnight success, no get-rich-quick schemes. It takes a while to build the right mindset as well. For me, I like to attack my challenges, my own personal challenges. When I became a realtor, I went all in on sales and negotiation training. As a real estate investor, I joined the top real estate investment network, and I missed all of 3 meetings in 10 years. For my fear of heights, I faced that fear head on as well. My legs used to turn into limp noodles when standing on the 10th floor balcony of my aunt's condo. Looking over the edge was another completely different challenge. Fast forward to today, I've since completed the CN Tower Edge Walk 4 times. I've bungee jumped off the tallest bungee from a building in the world. I've gone skydiving, gone treetop trekking a couple times. So treetop trekking is an elevated obstacle course in the trees, so it's suspended around 30 feet up in the air, and often there are zip lines. For a team building event, TAREI and I took the Stock Hacker Academy team treetop trekking in Hamilton. There are 5 levels or 5 obstacle courses, each progressively harder. You must be 5 feet tall to participate. Half the team completed the first 3 courses. TAREI, myself, Joel, and Megan completed all 5. And yes, it was pretty hard. We had some team members step out of their comfort zones big time to be up in the trees with us. And thanks to all the practice I've had now, I was actually very comfortable. I actually forgot about my fear of heights until around the 3rd level course. I am wearing a safety harness, so I'm in no real danger, but the same was true of my aunt's 10th floor condo balcony. So I'm not over my fear. I think I've just exercised that bravery muscle enough that I no longer have a noticeable problem. The same is true with real estate investing. TAREI and I just went firm on 2 duplexes that I'm buying off clients of mine, and the experience so far has been the easiest in our experience. With practice, a cash flowing portfolio and systems and the right relationships, it's never been easier. But those have been famous last words before. I'll have TAREI back soon on the show to detail how these deals went down and how we financed the investment using our whole life insurance policies. Don't know what a whole life insurance policy is? That's okay. That's actually the perfect segue to this week's guest. My friend Kathleen Van Den Berg, MBA, CLU, CFP. Yeah, she has a whole alphabet behind her names. She shares a lot of things in common with yourself and myself. She doesn't do mutual funds, even though she would get paid to do so. She's not a fan of RRSPs and prefers cash flowing real estate, stock hacking, her small business as a financial planner, and whole life insurance. More importantly, she borrows from her own insurance, whole life insurance, for the capital to invest in 3 properties, plus bankroll her stock hacking portfolio. FYI, really good financial planners charge a lot of money for their time, so we're in for a special treat to have Kathleen on for well over an hour, and she shares how she advises her clients to invest, which is also how she invests her own money. So please enjoy the show. To follow Kathleen, her website is wealthplancoach.ca. You can sign up for her newsletter there. Hope you enjoy the show. Hi, Kathleen. How you doing?
I'm doing great. How are you?
I'm excellent and happy to have you on the show.
You
What's
look
what's what's
well.
keeping you busy these days?
Purchased a new property in Oshawa, closed on that end of month. Got I'm still working on my Collingwood one that we closed on in April. Run into a few little snags there. We closed April 26th on that property, and that night the council met to decide no more development. So I'm like, oh crap. So
So that's how they're going to improve housing affordability, right? By stopping development. That'll fix it.
Yeah, the reason they're stopping all development in Collingwood is they're running into water issues. But I
That's a
mean, I'm
reasonable
just
reason.
a little peon. They've got mega developers that have houses sold that cannot build them. So anyway,
A sewer
that'll
line,
get
sewer
worked
issue?
through.
Not
So
enough
I'm
sewers,
not
or
too worried.
is it sewers or not enough water
Water, I'm
supply?
not exactly sure. Water filtration is what I thought.
Oh wow, okay.
Yeah, like the ability to clean the water, right?
Yeah, none of these are simple
So
solutions.
Yeah. So, and of course, stock hacking or trading, option trading. That's keeping me
Excellent.
busy. And the summer, of course, trying to golf, cottage, enjoy life. So,
Enjoy life. Who has time for
all that.
that? So so yeah, you've hit some snags with the Collingwood property.
Yep.
Uh, as we're recording, we're in early July, I think. How's the value of your property gone since you closed in April of your Collingwood property?
Oh, crazy, crazy. Because now they can't develop any more properties. So it's limited. So the property's easily gone up 150. We bought it for 600. So it's crazy. Everything's nuts.
Did you start the reno, or is this on hold?
Yeah, we rent out upstairs, and this one is a little bit different because bought it with a friend, and I'm going to keep it sort of part personal use because I love to kind of get up there skiing. And so if I can't legally duplex it, it's fine. I can just put a second unit in it and can Airbnb it when I'm not there if I want. So,
But it's gone, so it's not completely woe is me if it's gone up.
no, it's
150K.
not at all. Plus, I think I'm going to be able to get an exception granted based on, providing affordable housing. I'm not using any more money if I don't do a legal duplex. I'm still able to put a kitchen and a bathroom in. So there's no additional water usage. And it's safer if you have proper fire separation. So for public safety. So I think I'll be able to get an exception granted. So it's just a little bit on halt, but that's okay because I really just need it for when the skiing starts. So because I'm at my cottage now mostly.
It's funny with real estate, especially in Ontario, how there's always a silver lining.
I think when you go into
Sorry.
properties, it's really good to have a backup plan, right?
Mhm.
So you never know kind of what can happen, but if the property can, provide more than one opportunity, then you can shift gears. So
And you wouldn't have gotten into the property unless you didn't know the whole market situation was already that there's lack of housing.
right. Yeah.
And then now all these developers being stopped just increases the value of your property,
Absolutely. Yeah.
right? And all these economic factors like the price
And
of
the
lumber,
Oshawa
copper.
property that I closed on, I don't know what to do with it too. It's a big corner lot, and I'm really hoping that Oshawa brings in a coach house program. So I've been following so that you are very close with Andy Tam too on the coach house programs and things like that. So I'm really hoping this one will be a home run in the future too. But coach houses could be a year to 5 years out there. So I don't know.
But you're not hurting though. You don't need to depend on that strategy.
No, I mean, no, I can actually duplex this property. A lot of people have advised that I do so. However, I'm not. I think it's a mistake because I think when the coach house program comes in, they may not allow duplexes and coach houses. So I don't want to spend the money to duplex it and then not be allowed to coach house it in the future. So right now, I'm actually, oddly enough, this is really weird too, which I'd love to share with your listeners. There is such a shortage of single family homes. We've been spreading the word on duplexing for so long.
My bad.
Right. And now the rent I can get as a single family home is actually cash flowing. So I'm like, why should I spend that money? Because I'm not sure I'm actually going to get the lift because everything's skyrocketed. And with the rental shortage, I can actually cash flow as a single family home. So it's kind of like the tables have turned. So that's sort of been interesting. So I'm just going to rent it out single family home for now, see what the coach house program brings. In the meantime, I'm, it's more than breaking even and I'm fine. So
that's amazing to not have to go through the trouble of renovating and especially suiting. I know Oshawa is pretty easy in relation to all the municipalities out there.
Yes.
Can you share the numbers on your Oshawa property?
Yeah, I bought it for just under 7. I'm going to be able to rent it out for $3,000 a month plus utilities.
$3K. Wow.
Yeah, there's no shortage of interest. I have not signed a lease yet, but there is no shortage of interest at $3K a month. And it's, you
That's
know,
more
it
than I
might
get
be
for some of my
someone with,
duplexes because I have some old rents.
yeah, it's crazy. And then I figure that, you know, if that rent becomes stagnant in the future, I could do a rent eviction and duplex. I can always sell it. It's in a great area of Oshawa. And I'm hoping the coach house program will be great. So I can either build the coach house or sell it to someone else as a property that can have a coach house. So
Love it. You mentioned corner lot. Any chances for severance?
you know, there is a chance for severance. So I could take off, let's say, a third of my backyard and a third of my neighbor's backyard, and we could create a building lot. And I haven't been able to convince them to do so. Because I was speaking with Ryan Carr, you know, his motto, high and best use. And they believe that if they sever, that they will lose the value. They will lose the value of their property by doing so. And I was trying to impress upon them that no. So I need them to be able to sever, and they're investors too.
They live
Yeah,
there?
they rent. Their place is a duplex, but I cannot convince them that it would be smart to do so.
Interesting. Because in St. Catharines, one of our clients, they severed the property and then they sold the house.
Yep.
That had given up half of the lot.
Yeah.
And the market did this between when they bought like 2 years ago, the market had made that house worth more than what they paid for the entire property.
Yeah.
Right?
Yeah.
So
I mean, it's still going to be a healthy sized backyard, even if they sever off half of it. But anyway, I wasn't pressured. I said, why don't you just go talk to a couple of realtors and get some advice on that? Because I don't think that would be the case.
Don't talk to Ryan Carr.
I know. Ryan's Carr is the one that gave me the advice in the first place. So, but I can't convince him to sell, and I can't convince him to sever. So coach has to be my second option.
But this is still wonderful how many options you have.
Yeah.
And I think investors, because I'll first start off by saying that I don't believe there's really a wrong investment.
No.
It's just that some investments have more options than others.
Yeah.
Like for example, a new construction condo, what options do you have?
I say that to my clients all the time. As you know, I'm a financial planner. I advocate real estate, and for busy people, a condo can be like a turnkey solution that requires very little time, easy to rent. Yeah, you're paying condo fees, but easy peasy, and at least they're in, right? At least they're doing something. So action is better than no action. Right. Yeah.
You're hedging the market, you're hedging inflation, you're hedging currency devaluation, all things that are going on.
Yeah. I mean, I would agree, you know, like a cash flowing property is better, but at least they're in. Yeah. At least they're doing something.
Yeah, because I actually explained to a new construction condo investor, he asked me about how my property is performing. So I was like, these are the numbers of my daughter's house. I paid $245 for it. I put about $150 into it to make it because it was a student rental, and then I converted it to a legal duplex. That's why the renovation numbers are high, because I did basically do a bit of a double reno, and my rents are under $3,000, I think, combined, because that property's I had that over. Those rents are, I still have the original tenants from the duplex conversion. So they've been there for at least 4 years. So I get less rent than you will on your single family home.
But I'm paying current market prices too. So
and then so I tell him, like, these are my numbers and this is what the house is worth, and he goes, oh, my condo's done the same thing. But then I go, yeah, but my rents are higher than yours, and now the bank will give me more money for my next mortgage, right? Because I tell him, like, I can now go back and refinance that house and use that money for another property, versus with the new construction condo, you can't create that value and make that happen, right? Because could two houses ever not be better than one condo?
They could. I mean, if the condo's in a hot market, that's appreciating more than, your houses, but likely not.
Yeah.
But like I said, at least they're in the market. At least they're doing
Right.
something, right?
So Kathleen, you have a qualified opinion, being a certified financial planner. Would you rather have 2 duplexes in an Oshawa or a new construction condo at a wonderful location in downtown Toronto?
Oh, I'd rather have the 2 duplexes,
Right.
hands down. And for a variety of reasons. First of all, I think that Oshawa is going to appreciate just as much as Toronto. And I like the safety of having 2 families renting versus 1. So if something goes awry, I've still got income from the 1. And I'm getting more cash flow. Like if you want to grow, that cash flow is adding to my income. With a condo that I'm subsidizing, it's taking away from my income, albeit I'm probably making money on paper. But if you want to grow and have more qualify for more mortgages, you need that contribution.
Mm-hmm.
It helps you get more mortgages. It doesn't hurt you.
Yeah. So I think it goes back to often to what people's goals are.
Yeah.
I don't even know how I came up with the goal, but even say for example, say I wanted 10 properties.
Yeah.
It'd be much easier to have duplexes than condos, I'd imagine. You do mortgages too, so you know the answer.
Easier in what way?
Oh, in terms of financing, right?
Yes, absolutely. But they are more difficult to manage. You've got more tenant turnover.
Absolutely.
You might have lower quality of tenants. It all depends. I mean, I'm definitely in the get a duplex camp, but there are clients that I have that after speaking with them, they don't want to grow that much and they want the ease. And so for them, it makes sense, I guess.
Yeah.
So.
Oh, I completely agree.
Yeah.
Right. That is so much better than not having any hard asset.
Exactly.
Because there's lots of people with no hard assets.
Right.
And even worse, they don't even own their own home.
Yeah.
Yeah. And that's not for all markets. Like, if you're living in one of the stronger markets in Canada, like it's my belief it's better to own your own home. Because in my experience, our clientele, over 90% of them are using home equity lines or equity in their homes to purchase investment property. So if they didn't own their home, I don't know how they would have come up with the down payment and renovation money for investment.
Right. I mean, really, everything you buy is debt. Everything you buy is debt. We live in what's it called, a Keynesian society where money is really, really debt. So even when I go to buy my next computer, I'm either paying $1,000 for the computer or I'm paying down mortgage debt on it. And I'm making that decision. Really, everything is debt driven.
Interesting. So. How far are we allowed to go down this rabbit hole of
Keynesian
economies and fiat currencies?
Yeah, it's a big rabbit hole, but yeah.
It's a huge rabbit hole. And that's why I love talking to a financial planner, because you are qualified to have these opinions and advice. I am not. As we were discussing before we started the recording, we talked about Bitcoin. So before even Bitcoin, do you invest in gold at all, silver at all?
No, I have no gold. I have no Bitcoin. I've been option trading. I have never, and I could be wrong here, and I'm willing to admit that I am wrong, but I've never understood why gold is a store of value. And I don't really understand why Bitcoin is a store of value. And I figure for myself, I have real estate as a store of value. I don't need to have the gold and have the Bitcoin. And that's a personal choice because I have all this real estate. I believe in the story of the dollar being continually devalued. I believe in the inflation story. And Bitcoin may very well, it's just highly speculative. It could stay down for another 5-10 years. It could go up, but I personally don't. Many people in your circles do have some, but I have nothing. None.
And that's the, when your clients ask you about that, that's kind of what you share with them.
That's what I do, right?
Mm.
But maybe some people want to have less real estate than I do and have more gold. That's okay.
Mhm.
I've never really understand why one chooses that as a store of value. I just think a piece of real estate is much more functional. It's providing a service. Even like oil is a bad example, but oil provides a service, but it's kind of gone down in value. Well, recently it's been up, but at least I just don't understand why
Right.
a bar of gold is the value.
It could be a paperweight, a very expensive paperweight.
Paperweight, sure.
Actually, probably would be a best paperweight because you would never leave it on your desk.
How about you? You have gold?
A little bit of gold, very little.
A little bit.
Again, like you, again, I'm not right or wrong, I'm not an expert, but
Yeah.
you know, I kind of love the fact that real estate's self-liquidating, as in like our tenants pay down our mortgages for us.
Yeah.
In 25 years or so, we'll have a free and clear asset,
Right.
right? That will provide cash flow. So
Right.
we're Cherry and I were still heavily invested in real estate. I have this shiny thing option problem and FOMO problem.
Yeah.
So if gold or Bitcoin skyrockets, I want at least a piece of it.
Yeah.
And like no different than what I said about like for someone, a condo, a new construction condo or a condo is a investment for them. It's at least a hedge, right? In case you're wrong, in case you're right, you'll benefit,
Right.
right? Because I have personal friends who got into like Bitcoin and Ethereum for very, very low dollar amounts.
Right.
And
when they did, though, it was considered a pretty high risk investment.
And I'm pretty sure they all
If not still
were
now,
investing what they're willing to lose, right?
Yeah.
Generally, again, folks, this ain't advice.
I just don't need Bitcoin or gold, is what I think.
Right. Yeah, you already have a significant amount of financial wealth. Actually, for the investors who don't know, could you describe a bit of your portfolio?
Sure. We have 14 properties and 6 are joint ventures. So I would own half with an investment partner. And then I have a trading account that is around 450. I'd like there to be more in it. I am still, I think, lacking complete confidence that that's going to be like the income driver. So I've been learning a lot, making some mistakes, making some good moves, some bad moves. So, but yeah, that's sort of my portfolio.
Yeah.
And
sorry, go ahead.
oh, and of course my insurance. So I have a lot of whole life policies. My husband and I both have 2 whole life policies. We bought one when we were 40, and then another I think I bought when I was 52. I'm 55 now, and another one was when my husband was like 55, let's say.
Okay. All right. You said a mouthful. We'll go in order. Joint venture. So common question for folks is, how do I structure a joint venture? Can you share how you structured yours in terms of like what your responsibilities are versus your partner's responsibilities?
Yes, I am the working partner. So it was really an extension of my financial planning practice. I saw that a lot of clients didn't want to be landlords. So, and then when prices got so high, in order to grow, they needed to cash flow. So my value added was helping them to duplex a property. So we find the property, we have construction crews, we monitor all that, and we duplex the property, we tenant it, we do all the bookkeeping, and we do all the maintenance. So we're kind of we're the working partner. So they come up with the down payment and the renovation money. I do often we pay the line of credit costs. So for instance, if they borrow 150,000 to buy the house, we will first pay the line of credit interest, and then we split the profits from that. And usually the clients get about 50% of their money back within 6 months to a year, because we've done a forced depreciation of the property, right? We buy a 3-bedroom bungalow, now it's a 5-bedroom duplex. And then the rest of their money generally we anticipate will come back in around year 5 when we refinance the mortgage. That's the plan, right? It's going to depend on real estate prices and appraisals, but they've done really well. I mean, real estate in the GTA has done really well.
So this is a pretty active strategy then for yourselves, for yourself and your husband and your team.
Yeah.
So let me just reiterate, go over this again. So the partner gets their line of credit interest. They get, in general, obviously things happen, right? But in general, they get half of their investment back in the first 6 months.
Yeah, that's been the experience.
That's the experience. Again, folks, this is past. Past does not predict the future. We probably need a lot more liability
what
stuff.
happens is we build forced depreciation, and the properties have increased in value as well. So those two things have led to really good reappraisal values, which is how we can get the money back.
The passive partner, it's the mortgage is in their name.
Yeah.
In their credit. Okay.
Yeah. Yeah.
And the rental money and down payment money and closing costs.
Yep. Yeah, they're completely the money partner, but they get all the money back first. We split cash flow, like rental cash flow, as we go along, but when we refinance, they get their money back first.
It's a pretty good deal.
It is. I mean, they've been making 15 to anywhere between 15 and 30%. Would that be the case for a new person now? I don't know, because prices are pretty darn high, right? So
yeah.
But if it's something that they're willing to own for 10 to 20 years and it's paid down, and there's still no reason why they wouldn't be able to get all of their money back in 5 years based on a reasonable inflation rate and mortgage pay down and rental cash flow. Nothing's guaranteed, right? Prices can change, but that's the expectation.
Exactly, folks. Nothing's guaranteed. But again, you have a qualified opinion. What would you rather put your money in? Because lots of people in today's market, I don't blame them, think prices are high, they don't want to get in. What would you rather put your money in?
My money's still in three pockets: the trading account, the real estate, and the insurance.
So I'm guessing those are your 3 favorites.
Yeah, well, they're the only 3 that really it's in. Other than the snowmobiles and the boat, which are really bad investments.
We'll get to lifestyle in a bit. So thank you for the reminder. Because what you've done has afforded you a pretty nice lifestyle.
Yeah, no, we have a great lifestyle. We've been very fortunate. We have a cottage. We just bought this Collingwood, which is half personal. My husband has a golf membership, and we travel, and we've been very fortunate. We also have no children. Children are a really bad financial decision. But dogs.
They are, yeah, children are expensive. But what I shared with a friend yesterday was my motivation's never been higher.
Right.
Yeah. I do. It's funny because even though kids require attention, investment of your time and money and effort, my drive has multiplied since having kids.
Do you think that's because that without the foundation you're laying for them, the trajectory of their life would just be awful? I think that's the key, right? I hear that so much now with our circles. They know that they have to be able to launch their kid with a property or 2. Otherwise, they're snookered, right? It's
because if I'm naturally a worrywart. So then I think of if I was a tenant today, how are you getting into the market? statistically, you don't have much in reserves or savings. Statistically, not saying everybody,
Yeah.
right? And the market just got more expensive. And then how is if the renter today doesn't get a house, how will their children ever get a house? And then
Yep.
their children's children, and then there's children's children, right? And then you have all future generations will be tenants. And then statistically speaking, those who have at least home ownership are generally better off,
Yep.
right? Of course, that's not all markets. No, the one of the dumbest things about real estate when people say real estate always goes up in value. No, it doesn't.
No.
Go check
I
out Southern Europe, for example.
Oh yeah, I mean, I have lots of connections that aren't in the GTA, and they're honestly outside of the GTA. What has really continued to go up every year? Like, so I think in the GTA, our experience is made us very biased.
Yeah.
I mean, if you lived in Edmonton, Nova Scotia,
Yeah.
Florida, Europe, you haven't had that same experience.
So I know you lived in Alberta, Calgary, right?
Yeah.
Were you from there?
No, I grew up in Pickering, and so I'm in Whitby now, Brooklyn. But I was actually a mutual fund wholesaler, so I promoted investment funds as a corporate career, and they moved me out to Calgary, and then I got packaged out, and I said I was basically training planners, and I was very disappointed with the quality of planners out there in the marketplace, and I knew I could do a better job, but I also knew that, investment funds weren't getting people anywhere. That was back when like the 10-year track record on the mutual fund was zero. So people had earned nothing for 10 years. And so I wanted to be a different type of planner. And I knew that real estate is really sort of the best financial decision most people had made. And that's why I became a real estate focused financial planner, and very much marrying real estate with the insurance aspect.
All right, we'll get to that. So I did want to ask you a question from Alberta. So please qualify what you think about the market. Because I only bring it up because Alberta, Edmonton, Calgary, a lot of people are promoting it as a good place for investment. Do you still follow that market at all? Like, how long did you live in Calgary?
We lived there for a year and a half. We bought at the absolute boom in 2006. The average days on market when we bought was 2. Okay,
I thought this market was bad.
This was because it was before the invention of holdback offers, because they never did that. They didn't know about that. So the average day on market was 2, and so we bought our house for something like 400. Then of course it crashed. We couldn't sell our house for love or money. We needed to get out in 2008. That house was on the market for 9 months. See, Calgary's a big boom and bust town. It's very much oil driven. Edmonton, they say, is a better market because it's more government workers. It's more stabilized. To me, it's also closer to, Fort McMurray and all that. I'm just not sure it's a great growth market, but I think as us GTA investors, if we can't cash flow, I think maybe we need to think about going elsewhere to cash flow. And I don't know if that's Edmonton, Windsor, Sault Ste. Marie, Lindsay, I don't know, but if we want to continue to grow, we have to cash flow, right? So.
No, my plans for cash flowing is hopefully coach houses within 2 years.
Right. Yeah. There's still some opportunities with some unique properties. The property I just bought, again, in Oshawa has coach house potential. So I'm hoping that will come in. So we'll see. It's a long play.
Sadly, I think that you'll be able to do it before I'll be able to do it.
Who knows, right? We're all dependent on the
government.
Yeah, the government, the cities.
And not just the government, it's the people asking for these for more supply, right?
The rental market now is absolutely crazy. So I'm getting 3,000 for a single family home in Oshawa, which is nuts. No shortage of applicants. Almost 90% of the people that are applying, their landlord is selling their home, which I find shocking. The amount of horrible comments that I get on Facebook rental pages, the tenants are not nasty. They are desperate. They cannot find anything. The amount of posts like, I'm going to be homeless in 2 weeks. I've been living in a hotel for the last month. You know, I'm coming to school. I've got nowhere to live. It's bad. It's really bad. And I see it now because I've had some listings. I've had some turnover in my Lindsay properties and in Oshawa too, and it's bad. It's really bad.
Could be worse if you were them.
Yes.
It's better to be on the landlord side. And then I just want to put out like a general comment. If folks don't like the situation, like do something about it, right? That's a general comment to everybody.
Yeah, we've got to increase supply. Yeah.
Like our community, our circle of friends, our the people who are doing what we're doing, we're all trying to create more supply.
Right.
Right. Like in a perfect world, I don't know if it's your perfect world, but my perfect world is I convert my single family home into a fourplex. Now instead of housing one family, I can house 4.
Right.
I just need the government to let me do it. I'm completely willing to follow their guidelines and regulations, Ontario Building Code.
Safety wise, parking.
Yeah, completely willing to do it if it's reasonable, right? Just need them to let me do it.
Do you have a lot of properties that can do that?
We'll see what they.
Fourplex.
Well, the perfect world would be to if I'm going to do a duplex, I would dig the basement as well. Right. And so then I'd have basically a detached duplex on my property. Or if it's attached, I don't care.
Right.
I would perfect world. I would like 4 units.
Right.
I'm sure you guys are gunning for that too. Like highest and best use. Right.
Yeah. I mean, those really large houses on those really large lots, those will be those not in my backyard, right? They don't want that.
Yeah. So, and that's and then there's 2 sides of that coin. Right? Yeah. I get it. And also, as long as there's NIMBYs, they're going to drive up the value of our properties.
Yeah.
Because they'll restrict the supply.
Yeah.
If the neighbors are supportive of affordable housing, then we'll be able to create more units and then we'll increase our cash flow.
Yeah.
Right. So it doesn't matter which way it goes. You're still winning.
Right.
As a real estate investor.
Yeah.
Right. So, it's not the end of the world. Again, like where else would you want to put your money?
Yeah, I mean, I think the GTA is still good. We still got a healthy amount of immigration. We got all the millennials that, contrary to popular belief, do not want to live in their parents' basement for the rest of their lives. So they're buying, and we'll have children will buy, and we still got low interest rates. And I mean, rates may go up, but they're not really going to go up. They're not going to go up 3%. They can't, not with the amount of government debt. So
even if they did, it's not the end of the world for us real estate investors.
Yeah.
If anything, that'll cool the market and just allow us to buy more.
Well, 3% would really cool the market. Yeah.
I don't mind a balanced market.
True.
Like we're winning in all directions. Actually, it probably because people haven't thought about it for ages. If interest rates are higher, it'd be more expensive for our tenants to buy. For all tenants to buy. Now we all have more customers.
Yeah. And it's all based on affordability for sure.
Now the first question I asked you, I asked you before we started recording was, what are, because again, you're a financial planner. You're very different than the other ones out there. Mm-hmm. You're different than probably 95% of the financial planners out there. What are 5 questions anyone should ask their financial planner? Like,
Yeah,
I'm thinking more of like an interview, right? If you're sitting down for the first time with a financial planner, what should
yeah,
you ask them?
yeah. And as I stated before, I'll just say it again. It's a really tough question for me because I am such a different type of planner,
Mhm.
because I can be real estate focused. I mean, I think that the typical answers to something like that would be, how much do I put in my RSP, or should I be investing in TFSA? And those aren't the types of questions that I would ask at all. First of all, you have to see if there's a fit between you and the financial planner. I, for me, being very real estate focused, and if I wasn't a planner, I was interviewing planners, I'd like to know what my financial planner felt about real estate. Is it a good asset? Do they invest in real estate themselves? Because if I want to go that route with all and or part of my money, I want them to support me in this and help me to grow. So, I mean, I guess the real question is, are my goals aligned with their goals, right? Am I a fit for them? Are they a fit for me? Because if they don't believe in real estate, then they just wouldn't be a fit for me. How do they feel about debt? Uh, so many financial planners are kind of like, pay off your debt. I mean, yeah, pay off your credit card debt, but debt is an amazing wealth creation tool. And not a lot of planners see that. Not a lot of planners even look at your debt. It's so important. I mean, it's one of the most important things I look at, because it dictates their ability to grow, right? Do they have 20-year mortgages or 30-year mortgages? Are their mortgages readvanceable? Do they have credit card debt that they're not paying? And planners never look at the debt. Not never, but so many don't. And they're saying, like, contribute 10,000 a year to your RSP. Meanwhile, all they're doing is creating $10,000 of debt and credit cards, and that's not helping anybody. So if you're not looking at the debt picture, you're missing a major piece. I'd ask them, what's their typical clientele? What age group? What net asset value? What investable assets? Because am I really like a fit for them? And how often am I going to see them? What are their expectations on communication? How long, will we meet once a year to review my portfolio? Or will I never see them again, right?
Interesting.
Those are the types of things that I would focus on to make sure that it's a fit and align with my goals. And what's their competitive advantage? Too many financial planners are, in my opinion, just mutual fund reps. But
Is that a
if
bad
you
thing?
can really, if you can attack the tax aspect, like tax savings, that's a huge advantage.
Oh
And you
yeah,
do that,
because it's all about what you keep. It's not what you make.
absolutely. And it's not how much tax you save this year. It's how much tax you save over your lifetime. Because everybody focus, like the RSP focuses on how much tax can I save this year. But it's just a tax bomb later on. So the goal should be to save taxes over your lifetime. And I call this like liquidity, use, and control of your money. And in RSP, it's trapped. And there are other assets like insurance, like real estate, like TFSAs that are much more flexible and have higher uses, different uses. So
Kathleen, you mentioned you have a stock trading account, stock option
yeah,
account. Uh, what's your preference? Is it personal, corporate, TFSA, RSP, all the above?
I'm corporate. I'm almost I'm almost 95% corporate. Because and this is lends itself really to me, but because my financial planning practice is a corporation,
Got it.
I can move money from that to my holding corp, which I can buy properties with or whatever, and not take the money out in personal tax dollars. So it
Yeah, yeah,
means that I have more to invest.
yeah.
I mean, and that's a conversation that a lot of realtors should be looking at whether or not to incorporate. And I know Sherry, your wife, is a great source for that information. Not everybody should.
No, not everyone should.
You know, there is a cost to incorporating, but for me, it's been great. So I have more to invest and can compound it without paying the personal tax dollars.
Yeah. And then just a note on the corporation thing, like in a perfect world, everyone should do it, assuming you're going to grow.
Right.
For someone who's someone who's an everyday investor and plans on only ever being an everyday investor, not likely, unless you make.
Yeah, I mean, I'm not a tax accountant, but
yeah,
if you're going to grow, right, or if you're going to flip projects, then the money can stay in a corporation. If you're going to do any rent to owns, because that's considered income, not capital gains, those are the big reasons. Or if you have a corporation already, like an operating corporation from a business, then it makes a ton of sense to have a holding corporation as well. So those are the big four, I think, from my standpoint.
And we both do this. You're more expert than I am talking about this. I've actually been banned to talk about accounting. I think you can all guess who has banned me from talking about accounting. But again, you're more qualified than I am to talk to this. I just experience it myself without knowing where all the bank accounts are.
No, I think you played dumb a little too much, Erwin. I think you know what's going on.
I'm lucky in that I feel like I'm a glass that's full. So if I add anything, then stuff is going to spill over. And also I can turn a blind eye to the accounting side because I can play dumb to my wife because I know she'll take care of it.
Yeah. Well, I mean, you've also surrounded yourself with experts, right? Like your podcasts are financial planning experts, tax experts, people that have duplex experts, secondary suite experts, mortgage brokers, rent to own experts, stock hacking experts. So that's the connections that you have are amazing, really.
We try. And the whole point of the show was to cut through all the bullshit that's out there because there's a lot of shysters. Like you've seen it, it's natural. It's natural for people to be self-serving. We've all read the news on like banking scandals where the interest of the client was not taken at heart.
No.
From the bottom to the top, right?
Right.
So that will never be the show. We're just going to share what we do ourselves that we've experienced and works.
Yeah, I mean, I actually believe that RSPs are 9 times out of 10 not in clients' best interests. Right. If you run
for our community, or you think everybody, like general population, 9 out of 10.
9 times out of 10, 8 times out of 10, yeah.
Wow. Okay.
If you're lower income, then you're not going to be you're not in a high tax bracket now, so you're not getting a big tax advantage now. And you're still going to be in a low tax bracket in retirement. You're not going to be in a lower one. If you are like uber wealthy and have super high income, yeah, go ahead. It's such a small, you're only allowed what, 27,000 or something. I forget what the limit is this year. I don't even pay attention to it. It's not that significant.
Yeah.
Right. And then it can just be like your safe, boring money. It's not your wealth creator money. It's a tax tool. And then in between, again, liquidity, use, and control of your money. But the planners are all focused on that. But I mean, it's
easy to pitch, right? Don't pay tax today.
Because everybody's focused on what the tax savings will be this year.
Yeah.
Not over their lifetime. But if you take, if you run the numbers,
that's a good nugget.
I mean, I can make commission on the $25,000 a year over the next 10 years that the client puts into a mutual fund. And that's my bias. But if I take that money, that $25,000, and I invested it in an income property, and then you run that money on 20 years, even like withdrawing the RSP in the future, hands down, the investment property wins in the projections anyway. There's
Mhm.
certain projections on what real estate will do and what the cash flow will do and but there's projections on what the investments will do as well.
So, Kathleen, I love this discussion. And as always, no one has their questions in advance. So, what would you tell someone who's starting out as a financial planner? Like, Kathleen, I love what you're saying. I agree. Say they agree with you. Mutual funds are on the way. They're probably not being able to understand how you actually make a living as a financial planner outside of your real estate.
How I make a living?
Yeah. How does a financial planner who does not sell mutual funds make a living?
Um, well, for one thing, I have my own wealth, and I have my own income generators with trading accounts, insurance, and investment properties.
Mm-hmm.
So I'm not desperate to, I don't have to bring in income from my financial planning practice, and I do.
Mm-hmm.
But my financial planning practice is more heavily weighted on insurance, specifically wealth insurance, where people invest in insurance and then it becomes this amazing line of credit that they can use to, and they can access it during their lifetime. They don't have to die to get their life insurance. They can access it during their lifetime. But
What is this magical insurance? How come no one's talking about it?
Magical insurance? Whole life, permanent cash value insurance, has different names. But basically, I mean, like the wealthy have been using this type of insurance for years. It's an amazing tool because it grows tax-free. I mean, most people need insurance anyway, but if you can grow your wealth tax-free, I mean, the average return on life insurance is probably the equivalent of like 7 to 8%. Now, of course, I can't tell you what you'll make on the insurance policy because you can't tell me when you're going to die, but based on life expectancy, it is an amazing tax-free rate of return. But the return is actually way better than that if you use it for wealth strategies, because you can borrow against the money for investment properties, for the trading account. I have completely funded my trading account, so there's around $450 in it from my insurance policies. And I have bought 3 investment properties. I'm 55 and I've had the insurance in place since 40, right? But it grows exponentially. So during your, and this is the key thing is during your wealth building years, you want to use the cash value for wealth building. You should use it for properties, for trading, for things that can create more money. It's basically a big line of credit, but plus you've got this death benefit at the end. And you know, if you live to 100, you can spend the entire death benefit down. But the biggest advantage is it saves people's retirement, because when they have insurance, like, so the goal is at 65, I will not have borrowed against the policies for my properties and stuff. I will pay it back so that I have this amazing line of credit that I can derive a tax-free income from. Now, without the insurance, so let's say you're worth $1 million at retirement, just to make it easy. That $1 million can only safely give you $30,000 a year, because that's that safe withdrawal rate. Because when you're older, your income is going to be subject to volatility. So if you have a tenant that doesn't pay, or your plan was to refinance and pull money out and the mortgage rules change, or it's a bad time to sell your real estate, you have no other option. But with the insurance, you can go to the insurance policy and allow the mortgage rules to rebound, give yourself time to evict the tenant, whatever. So you can create twice as much income from that same asset base when you have that insurance, right? And that's the key, is it really saves people's retirement. I mean, before you introduced me to stock hacking, my goal was to have an income of $10,000 a month and pay 0 tax on it. Because my insurance income is 0 tax from my policies. And then my real estate, I can depreciate those and not pay any tax on it as well. Of course, now I'm probably going to be making some money on the option trade.
Oh,
and we'll have to pay some tax.
worst thing ever.
Maybe I'll move to Bermuda, Panama, something like that.
Is that financial planning advice? Bermuda, I'm writing notes. Bermuda, Panama. So how come people, before we were recording, we were talking about it before, like how come no one was talking about whole life insurance before?
Higher end advisors that we're working with, the uber wealthy, we're definitely doing it. But I mean, the uber wealthy were the people that were buying real estate before too. It's just a more complex sale. I mean, it really lends itself to business people too. So business people can pour their money in these policies, but take it back out for their business. But that's what real estate investors are. They're basically business people. So
They are business people, in my opinion. Like,
yeah,
owning a property is a small business.
Right. So it's a no-brainer if you're a business person, because you still have access to your money. Even if you weren't a business person, it saves your retirement. Like, insurance is a way better vehicle than an RSP. And I show people that.
Sorry,
but
specifically
even
whole
if
life.
whole life,
does that include term life too?
No, it doesn't include term life.
Got it. Term
life is really an expense because there's very little hope of ever having a return on it. And don't get me wrong, it's not that I don't sell term insurance. There's many clients that, because most people can't afford all the insurance they need in a permanent way, especially if they're younger. So term insurance will fit that bill, but it's specifically for a term, 10 years, 20 years, right? And then it just gets way too expensive at 60, 65, and you end up dropping it. So you've put money into it. It's really renting. You put money into it the whole time with no value added. Like, whole life permanent cash value insurance is very much like a house. You put money in, it's tax-free growth, and you have a line of credit that you can access. Imagine it's like buying a house where the mortgage is to your age 100. So if you're 50, it's a 50-year mortgage. If you're 30, it's a 70-year mortgage. But and the value of your house grows and the mortgage is paid down. The value just grows exponentially. So it's just an amazing tool that way.
Now, I'm sure people are asking, what is the magical insurance cost?
Well, it's the same thing as saying, like, how much does the house cost? Like, are you buying, a condo in Sault Ste. Marie, or are you going to the bridal path? So whatever you put into it. But here's the trick. The real question is, how much insurance do you need?
Okay.
Right? Now, the amount of permanent insurance that I always recommend for client is, we project, let's say, to age 65. And at age 65, we want to have enough cash value to provide 3 to 4 years of income. So if you tell me that you can live off of $100,000 a year, I will encourage you to get as much insurance that at age 60, there's 300,000 to 400,000 of cash value in the policy. That's how much. And what that costs depends on your health, your age, your sex. But that's how much you should be putting away, because we want our clients to have 3 to 4 years of income buffer in retirement. I mean, option traders, especially option traders, like, my goal is let's say 2% a month. So I'm $500,000, create 10,000 of income a month, let's say. But I know there's going to be months.
That's pretty nice.
Yeah. I know there's going to be months that's not achieved.
Absolutely.
Okay. There might be a year period it's not achieved, but I need that money because I'm retired and I need it to live off of. Well, where do I go? I either have to cash in my trading account, which is down, right? Because it didn't generate that income that month. Or I just go to my insurance policies and allow my trading account and my stocks to rebound. And that's a perfect example of why we need to have permanent cash value in retirement.
Right. So it's not even just death benefit. It's like cash flow insurance.
It protects your assets.
Yes, you don't have the liquid assets.
It protects your income in retirement. That's the ultimate goal.
Yeah.
it's great that it's infinite banking. It's a big line of credit. That's great. But that's not, to me, the primary reason. In your wealth building years, yeah, absolutely. Use it as infinite banking to create more wealth. But in retirement, if it's protecting your income, because imagine that you're 60, you don't know if you're going to live to 70 or 100. So you have to, without the insurance, you have to take out just a little bit of money because you don't know how long you're going to live. But with the insurance, you could say, okay, let's assume I die by 80. Let's just spend all the money down, and then it's recreated in the insurance policy by year 80 because it's grown. So you have much greater income with this insurance than without, with the same assets.
Mm-hmm. Mm-hmm.
Also, I'm not sure I want to have as much debt as I have now when I'm 60, 70. So does that mean I'm going to put like half my money in a GIC earning nothing? Maybe, because, so I've got half my money earning nothing, let's say, and half my money earning 10%, let's say. So my average return is only 5. I can't live off of the 5, right? But with the insurance, I don't have to have anything in a GIC. I can be fully invested in the equity market because my insurance is earning 8% and it's tax-free, and it's basically a GIC replacement in your older years, which allows me to be fully invested in more aggressive investments when I'm older, which I wouldn't be able to do without the insurance policy. So again, I can create greater wealth and greater income with the policy than I would be able to without it.
Right. And so you have, it sounds like you have like 3, I don't know if they're income streams, but you have your practice, you have your real estate, you have your trading account,
Yeah.
and then you have your policy, your whole life insurance policies.
Yeah. 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 No gold, no Bitcoin.
They don't create cash flow anyways, but
No.
I'm sure someone will come on the show eventually, will tell us that you can lend it out and stuff. It'll come eventually, but man, that's bleeding edge. Anyways, where is it going? So I want to. We never focused on this segment of people is financial planners. Is that how you probably would have done it all over again if you could talk to your 20-year-old, 30-year-old self? Is that the financial planner you would have liked to start out as?
Yeah, I mean, absolutely. That's what I wish I bought my first property. I want to say I was maybe 35, which is late, I think, in life compared to most. If I talked to my younger self, I would have bought, earlier. And even whole life, that's a tricky question. Should you buy, should a 30-year-old buy whole life? Or should they buy real estate? The price when you're 30 is so much less anyway. You're going to pay the same no matter what. You're either going to pay more money at an older age, but basically you're going to pay the same. The risk is at an older age, you're not as healthy. And so then you will pay more, or even uninsurable. So the best time to get the insurance is now, because you're never going to be as young as you are now. So, but yeah, I mean, and the trick with insurance too is you want to buy as much as you can comfortably afford now, because you probably won't buy more later. Certainly not beyond age 60, you're not going to buy more insurance. It's just too costly. And we bought our last policy at 55, I think, and we're done. It's just way too expensive now for us, right? And my husband has some medical issues. He's a diabetic now, and he's on cholesterol, so I weigh too much. It's just too expensive now. So
yeah, so I think I pay like $1,000 a month. Trey and I pay somewhere around that, and I think that's one of the reasons why no one discussed it before. Was it's a very specific person. Not so much in our community. I think lots of people in our community it makes sense for, but general population, and I'll clarify that and provide some context. I believe the statistic is if you don't have a pension, CPP doesn't count. If you don't have a pension, I believe it's over 60% of Canadians will never be able to afford to retire. So those folks probably shouldn't be getting whole life insurance. I'm just guessing. I'm not a financial planner.
Absolutely. So actually, that's a good point. People with pensions don't need it as much, right?
Right. Yeah.
So imagine that you're a retired teacher or police officer or firefighter. If you live too long, that's okay. Your pension lasts as long as you live. But that's not me. So I need whole life insurance. Yeah. If
Most real estate
inflation,
investors don't have pensions. I think that's why we're real estate
they
investors.
don't. If the firefighter's pension investments are in the shitter, they still get paid, right? Because that's the risk of the pension investment management team.
Right.
That's not me.
Benefit, right? That's
not me. If my investments go down, I have to reduce my income, and that's why I need the whole life, right? So if you are a teacher or police officer, you can live along and you don't have to worry about investment risk. But if you have those risks, that's where the whole life can create a much greater income for you in retirement, because it insures those assets, because you've got 3 to 4 years. So you can wait for your investments to rebound. And if you live too long, it just creates more cash value. So you're okay. But without it, like in the 80s, most people had defined benefit pension plans. They didn't need the wealth insurance, but now it's reversed. They need it.
This is a great conversation. I hope people listen to this one. So I want to ask about stock hacking, about your trading. So I want to first start off by saying thank you for having so many kind words on the show and previous shows, and also to your own
No,
I
promote it when I can. I promote it in my newsletter. I know you've got another beginner class coming up October 1st to 3rd. I'll be promoting it out to my network too, because I think it's a very valuable tool.
So can you share to your own experience how it's going and some of the lessons you learned? maybe what you would have done differently.
I think that the kind of best practices, you've really got to invest in your education. You've really got to invest in a disciplined approach. I'm doing
which you've demonstrated very well with your real estate, your practice, your whole life.
Yeah.
Because whole life you need to be disciplined to be buying whole life, because it's not fast money, like nothing like that.
No, it's not fast money, but yeah.
It's
as long as you're buying something you can
long-term protecting
afford.
Your wealth. It's an investment, long-term investment.
Yeah. I mean, I'm probably tracking this year maybe about 5% return, which is not, I mean, I think I hear a lot of people doing absolutely stellar, and I've made a mistake. I'll be completely honest. I have way too much GME stock. I went down a little bit of a rabbit hole on that. I've done all this research on short selling and the short interest and the potential short squeeze, and the premiums were really high, and so I've done all this research, and I made the mistake of it's position sizing. I didn't follow a good position sizing rule. So even though I believe in the sort of what I'm doing and the call I'm making, I went too far down that. I invested too much in my portfolio in it. So, I mean, maybe Jimmy will pop up beyond, 200 and I'll be fine. That's what I'm expecting, right? I might just have to wait. But I like what you're doing with, the basics. I like the lead trades are great for beginners and discipline and learning. And I like the idea of the advanced course. If you really want to take it to trading for a full-time kind of gig, I think the advanced trading is good. I like the idea of spreads for minimizing risk. Also, I mean, not to get into the weeds, but they have spreads can have a great return on margin, which is really what people should be looking at. But there's a lot to,
and downside protection.
Yes, downside protection, which is why it doesn't have as much of a margin requirement, which is why when in big market swings, you're not going to get into as much trouble. So, but I think it's important for people to have like a trading plan, a disciplined watch list, that they have when they learn, when they go through the education process, that they learn and they have a disciplined approach that they kind of stick to, right? It's hard to like FOMO, you like all those people that made millions of dollars on Bitcoin or on GME or whatever. That hasn't been my experience. And I mean, also I've
and then just to clarify, for every one of those, there's someone who lost.
No, it's probably 4 people have lost. Yeah. Like I took a course in technical analysis, which was good. I learned a lot, but I think it gave me also a little bit of false security that I felt like I could look at a chart and know the direction it was going and know that it was going to pop up. And that's just not true. So when I did that, I fell away from my disciplined approach, right? Mm-hmm. So I want to kind of fix this, hopefully this GME thing and get out of that and go back to the disciplined approach where I have a more disciplined watch list of stocks that I'm willing to own at prices I'm willing to own. I don't mind using margin, which a lot of people don't want to use any margin, and that's their call, but use it safely. So, but the tough part too is, you got to start with paper account trading. Like that's how you learn. Mm-hmm. But even like 50,000, I almost don't feel like it's enough of a bankroll. Although,
well, to learn is fine. Even
is it?
I think less is. I think 10,000 is a perfect amount to learn with, because it'll force you to be
you know what?
efficient.
You're probably right, because if you can use spreads, you're right. But when I was learning, I didn't know about spreads, so I didn't. So for me, it probably wouldn't have been. But if you learn about like the way you do it with spreads, you are right. You can definitely.
That's why the course evolved, right? That's why the course had to stop.
Yes,
had to evolve from a single strategy to 5 strategies.
Right. And that's key too, right? Like when I started about almost exactly 2 years ago. And I started with a small amount of money, and it did, really well. And then when March happened, when the crash happened, of course I didn't do well, but I had very little money in at the crash. I might've had 25,000, but I had another 200 to invest. I just didn't feel like I had the knowledge to put it to work. But when the crash happened, then I put it to work. So
the new stuff was on sale.
Yeah, it was on sale. Yeah, absolutely. And but
I think that's a great point, is that we're not just in the market. It's not like, to me, it's not like real estate, but the market will always has just taken care of us.
Yeah.
I think with the financial markets, one should be more financially more opportunistic.
Yeah. Right. Because there's different markets. Yeah, there's different markets. Right now, volatility is very low.
I don't know about today.
What's that?
I haven't looked, but
well, 2 days ago, I think the VIX was at 15. And of course, we've had some pullbacks the last couple of days. It's probably bounced up from that. But there's, in the last 2 years, we've been at market highs twice, right? We're back at market highs. Mm-hmm. So there was some opportunity. But I've learned so much, like almost like even seasonality, like a lot of the pop-ups and stocks are October to December. That whole go away in May, but I have a bit of that addictive gene. Like I really do like it. So I'm not the type of person to just put the money aside and wait for September either. So, but I also think what you're doing in terms of creating a community is also great. I think accountability partners would be great that looked at your portfolio and said, what are you doing? Why do you own so much GME stock?
Chris Lewis, could you I'll pay for lunch for you and Chris Lewis to have lunch together while he reviews what you're doing.
Oh, we had lunch all the time. They came up to our cottage, and but there was more think rum drinking than disciplined trading. But no,
Hopefully
he's a
not.
great,
Hopefully didn't mix the two, right? Trading and rum drinking.
yeah, no, he's a great source. And yeah, we actually are going to meet. He's going to try and help me. But yeah, the community is really great.
Mhm.
And I see, like, after the courses, that groups will get together and have WhatsApp groups and share their trades and share what they're doing, and helping people like look at charts together. And and you have to decide what type of trader you're going to be too. There is definitely a type of trader that can just go 15 minutes in the morning, 15 minutes at night. And then there's other types that are watching the market much more closely all the time.
Mhm.
And I'm doing that, and I don't want to do that, right? The whole goal is to have more free time. So
We should have more talks off camera.
yeah.
I'm the slower path now.
Yes,
Right.
you've changed, right?
Yeah. I want I want to experience it all.
Yeah,
And also, if the returns were there, yeah, like in this current market, yeah, I'd spend more time.
right.
But it's more of a cautious time to me, right?
It
Again,
is.
folks,
It
this is
is.
not advice whatsoever. This is all opinions and past experience shares and some historical facts. But like you mentioned, us being at historical highs, I'm not really interested in getting in right now
Yeah. I
into
mean, I
anything
definitely
significant.
need to take the advanced course, and not only just to learn, but the support of the trades and trade ideas is great too. So
Yeah. Because it's not just what trade to do, when to enter, what to enter. It's also when to exit.
yeah, you talk a lot about that. You also talk about, what do you call it? Repair,
Debt
trade
repair. Yeah.
repair.
Hmm.
Yeah, because inevitably some trades will not go the way you
Yeah.
planned, right? So
It's no different than real estate. Like sometimes you have to repair
yep,
a bad property, a property that went
yep,
sideways.
yep, yep. How do you get the tenant out? How do you fix it? Yeah, absolutely.
Yeah,
So
because in my opinion, just I'm a bit of a geek. I like to have pretty much every tool in my toolkit, right? So it's no different than real estate. I have my property manager's been instructed to use landlord credit bureau. That's a newer tool in our toolbox, tool belt, whatever. I want all the tools. No different than I want whole life insurance. It's another tool for me in
right,
order to get to that aligns with my goals, right? I want to
yeah,
protect my assets. I don't want this liquidate assets because of whatever reason. I need I need I need multiple streams of income, and I
yeah,
need a means for more down payments, renovation budgets.
yeah.
Oh wow, we were really long on time. Um, Oh, so Kathleen, I haven't done this in a while. So I want to ask you, without any prompting from me, anything you want to share with the listener, all 17, 18 of them? I think we gained one along the way somewhere. Any general thoughts about the market, or some like words you live by, or anything you want?
Um, let's. I really like what you asked me about questions that you should ask your financial planner, and I'm really kind of coming back to that. And I think it's important to have financial advisors, but they should be aligned with your goals. And I think it's really a great idea for people to interview different planners to make sure that it's aligned with what they want to do. So I like that idea.
Hmm.
Um, but this is your financial future too. So you have to invest the time. I mean, so many people spend more time organizing a vacation than they do, going over their finances in a given year. So, but yeah, I mean, you've got a great community happening, and I mean, there's other communities, but get yourself involved in a community, right? So
Hmm.
with the help. So that's just, I
Speaking
think,
that,
what I want to share
speaking of communities, like I can't wait for
in
stuff.
person.
Yeah,
Yeah.
I don't know how big a venue we're gonna need. I'm sure everyone's dying to see each other.
How many people can you take in your new spot?
Oh, well, 50, like we have seats for 50, but
50,
it's
yeah.
more about what the guidelines are going to be, right?
Oh,
And we're
yeah.
happy to rent out a space, but again, like like for our business, we had to compete with, like as a we had to compete with venues who rather have a wedding than us, right? Because everyone who's ever had a wedding knows you pay a lot, right? So the venues want weddings; they don't want meetup groups like us. And then all the educational institutions, uh, they don't even know if they want outside parties to their
Yeah.
property, right? They don't want the risk, the
And all
exposure.
that pent up demand for events, like all those
Yeah.
people that postpone weddings and
Because that they will definitely outbid me for a space. So maybe we meet in a park. But we'll definitely have more get-togethers. I'll see you next week golfing.
yes.
Hopefully, I'll see you in a few weeks after that on the east side golfing. And yeah, I can't recommend enough. Everyone go see people again when the province allows.
Yeah.
And I cannot wait to host meetups again for stock hacking for real estate, because there's just such great learning, right? And experience shares.
Yeah. And the market's ever changing and ever evolving. So it's not like you can kind of take a course and it ends. You have to be kind of on top of what's happening. So the meetup groups and like-minded people are great.
Yeah. I think everyone misses them.
Yes, for sure.
Yeah. Hopefully we'll see you in the fall when we
Yes.
announce our first events.
Sure.
All right, Kathleen, thank you so much for doing this. Oh, where can people follow you?
Wealthplancoach.ca is my website. Sign up for my newsletter is good. I write lots of almost all my articles I write myself because I'm such a different type of planner. So you'd get a good idea of where my headspace is and how I approach things. And maybe it's good for you, maybe it's not.
Yeah, because you've done pretty well for yourself, have you not?
Well, I mean, I've been very real estate focused. So yeah, I have. Yeah. And the whole life, honestly, I love selling whole life because it's such a great tool for clients. And I can't stomach the idea of selling them mutual funds that go down or not going to provide them with the type of retirement that they're going to need and going down this path. So I feel much more comfortable helping them get real estate and whole life. So it's a great, and I know you've got an affiliate with Jason, is it Lowe?
I technically don't have any affiliates with anyone.
Oh, okay. Well, connections and things like that.
Mm-hmm, mm-hmm.
Yeah, you've been really well. You've seen what the wealth insurance can do too. So
I'm still early. You have much more experience than I do.
Yeah. Well, yeah. Been in it longer.
And smarter. So.
It's my safe money.
And everyone could use more safe money.
Yeah. I mean, we put $65,000 a year into our insurance policies, but it's not a cost because we can take out 100. So that's sort of that clue.
Yeah, I'm sure. Okay, so folks, if you want to understand how Kathleen does that, how she puts in 65,000 and takes out 100, wealthplancoach.ca. Kathleen, thanks so much for doing this and taking.
Thank you for the opportunity as well, and we'll see you soon.